Strand 6, Standard 2. Have you chosen your type of business? Are you going to be a sole proprietor, a partnership, an LLC, or a corporation? So we could talk about those types of businesses. I've got links up there, types of businesses, pros and cons of businesses, franchises. I'll show you just briefly some of the things that are included in those links, but I will let you research it. It makes for a very boring lecture. Number 1, describe the various types of businesses.
Let's start by taking a look at the sole proprietorship. A sole proprietorship has the simplest operating structure because it really only needs one person to make 100% of the decisions, you, the owner. Most states don't require sole proprietorships to formally register, which means you also won't have to pay filing fees. The sole proprietor may still be required to obtain special licenses or permits depending on their business. Because the owner is the only official in a sole proprietorship, they are liable for all obligations and debts. The owner is also taxed individually. Net business income or loss is combined with personal income and deductions and taxed at individual rates. That means you won't have access to the potential tax advantages of a corporation. The next business structure we'll look at is a partnership. A partnership requires, you guessed it, at least 2 partners. Partners are usually equally responsible for business decisions. However, if you have a limited partnership, one partner can be silent by contributing money without having any say in the company. It's recommended for partnerships to register with the Secretary of State's office and obtain all licenses and permits. Like a sole proprietorship, owners may be fully liable for all debts and obligations. And each partner is taxed individually through personal income tax. Now, forming a corporation can be a lot more complicated than starting a sole proprietorship or a partnership. However, the extra cost and effort can be worth it in the long run. A corporation must have directors to lead the company affairs and approve transactions, officers to oversee daily operations, and shareholders to have ownership in the company. However, in smaller corporations, it is legal for one person to act as the sole director, officer, and shareholder. To form a corporation, you must file articles of incorporation with the Secretary of State's office, which means you'll need to pay a registration fee. You'll also be required to obtain proper licenses and permits. Corporations must comply with more regulations and tax requirements because owners are generally protected from personal liability. Liability instead is placed solely on the business entity. Plus, corporations have access to tax credits that sole proprietorships and partnerships don't. And how you pay taxes is determined by whether you file as a C corporation or an S corporation. C corporations pay taxes at corporate income rates, and their shareholders are taxed personally for any distributions or dividends from the corporation. S corporations are pass-through entities, which means they are treated like sole proprietorships and partnerships and not taxed at the corporate level. There are limitations on what can classify as an S corporation, but most small businesses qualify. Finally, we have limited liability companies, or LLCs. LLCs give you the flexibility of a partnership and the protection of a corporation. The catch is, you can only form for a limited period of time. You'll have to register a unique business name in your state and obtain legal licenses and permits. And you must file articles of organization with your Secretary of State. It's not required to write an operating agreement, but it's recommended that you do, so you can adhere to clear rules and regulations. As the name suggests, a member's personal liability is limited when it comes to business decisions and actions. Generally, an LLC is taxed like a sole proprietorship or partnership, and income is passed through to the members as ordinary income.
How much money do franchises actually make? And why is this information so impossible to find? We're going to take a look at 5 of the biggest names in food today and how much owners are actually making. We're also going to compare the food franchise earnings with other popular industries like beauty, cleaning, senior care, staffing, and more. We're going to end up exploring franchises that can make as much or more as some of the big name food franchises for an investment that is 10 times less. Today on Franchise City. You know, everybody thinks they want to own a food franchise. And when I ask people why, nobody really has a good answer. They think that food franchises are the biggest moneymakers. But according to a Franchise Business Review report, 51.5% of food franchises earn profits of less than $50,000 a year. Only about 7% of food franchises have profits over $250,000. Keep in mind also, if you're looking at a very established big name food franchise, you're going to get the leftovers in terms of territory. In most cases, the owners that are making the most money are the ones that got their locations a long time ago. They received the best territory. So we're going to be looking both at gross and net revenues today for our aspiring entrepreneurs. Annual gross revenue, that's the total amount of money that comes into your store for all goods sold. Net income is how much money is left after you pay your rent, your payroll, your royalties, insurance, and everything else. Net, that's really the important number, because who cares if you're earning 10 million if your expenses are 11 million. The single highest grossing food franchise on the QSR 50 is Chick-fil-A. Chick-fil-A, an average store, generates $4.16 million a year, and your investment to get into a Chick-fil-A is only $10,000. But Chick-fil-A has a very different franchise model than other franchises. Owners do not receive a traditional revenue split. They don't have any ownership of the store. You're going to earn a solid six figures. You'll have limited risk. You'll be part of a great organization with traditional values, but you don't own the store or ever gain any equity. And now, it's also very difficult to get a restaurant. Chick-fil-A receives tens of thousands of applications every single year. They typically open between 80 to 100 restaurants. Buying a Mickey D's, that's going to cost you 1.2 to 2.2 million. That's not including your real estate. Now, a lot of people think that these big numbers include real estate. They absolutely do not. But the general consensus is that a reasonable average net expectation for a McDonald's restaurant is about $150,000 a year. Opening up a Burger King restaurant, that's going to set you back between 1.8 and 3.2 million. Mean average sales of traditional locations for franchisee-owned stores that were open at least a year again was $1.4 million. Now note, the average gross revenue for a Burger King is about half of what a McDonald's location is. Their highest grossing store across the entire system in the USA was 4.3 million, which is about a third of the McDonald's highest grossing store. Again, your rent costs, your local expenses, and all these other factors are going to greatly impact your net, what you're taking home. However, a 6% net revenue figure seems to be the reasonable average. That puts a Burger King franchise profit, single store average, at about $85,000 a year. Now again, some locations lose money, some are earning far in excess of that number. Dunkin' Donuts. So their financials in their FDD break down earnings throughout the entire country by region. So at the high end, if you have a drive-through freestanding building in the Northeast, you're going to average about almost $1.4 million. And at the low end, a freestanding restaurant with no drive-through in the West, you're only going to be taking home $974 as an average. Your cost to open a Dunkin' Donuts is about $465 to $1.5 million, again, not including your real estate. Dunkin' brand's average net revenues are estimated between about 8 to 12%. Again, that can fluctuate. We're going to say 10% average. So if your store is doing about $1 million, you could expect a profit of about $100,000 a year from your Dunkin' Donuts. The last food franchise that we're going to look at on the list today is Subway, and the average cost to open a traditional location is about $233,000. Now, unlike the other franchises we spoke of today, Subway does not indicate earnings in their disclosure documentation, but we can get that data from the QSR 50, and we can see that an average Subway location grosses just over $400,000. Now that's 10 times less than an average Chick-fil-A. Subway is actually the second lowest on the chart, with only Baskin-Robbins lower at $360,000 a year. Now, sluggish revenues are very likely a big reason they closed another 866 stores last year. Now, even at a high 10% margin estimate, an average Subway single store is going to net you about $41,000 a year. Again, some locations lose money, some make a lot more. That's just an average. So you can see that most people's perception of food franchises being these huge moneymakers is not quite valid.
All right, now that you've learned a little bit more about the pros and cons of the different kinds of businesses, go ahead and pick one. I will recommend an LLC for startup businesses, but go ahead and pick one just so you can continue to go through the process of being an entrepreneur. All right, now let's talk about organizational structure. Before we watch the video, just briefly, that means Who do you have in what place in your organization so that everyone can be happy and so you have the most efficient way of getting your product or service to the market? So typically that means you have some kind of a manager, you have some kind of a president or CEO, there's the owner, and then of course employees in various positions. So how is everyone going to work at their best and be happy and feel like they've got good working relationships with their boss? And how is it the most efficient for getting a product out the door? So for example, would you have a business that has 5 managers all managing 1 employee? In construction, do you have 5 managers telling 1 person to swing a hammer or dig a ditch with a shovel? That's not very efficient. Flip that around maybe. 1 manager or supervisor and 5 people actually getting some work done, right? It's kind of like you actually have to have boots on the ground. You have 1 general, but you have 1,000 soldiers actually getting the work done. So let's take a look at that video and then we'll talk about organizational structure.
Now meet Nancy. She's the Chief Executive Officer, or CEO, of Awesome Corp, a company with 35 employees. Well, this is Jim. He's the Chief Operating Officer, or COO, of Awesome Corp. He's Nancy's second in command and reports directly to her. Jim oversees a wide variety of areas, including production, sales, and marketing. Mutlu is the Chief Financial Officer, or CFO. Simply put, he's responsible for the financial health of the company. Nancy, Jim, and Mutlu are Awesome Corp's executive team. But Awesome Corp has more employees than just 3. A lot more. Let's take a look at the financial department. As you remember, Mutlu is the CFO. Now this is his team. Layla is a senior receivables accountant. She manages accounts receivables. That's the money coming into the company from its customers. She makes sure invoices get issued and that Awesome Corp gets paid on time. Well, this is Thomas. He's Layla's peer, meaning that they are likely to receive comparable compensation, and they both report to Mutlu. Thomas's area is slightly different, though. Thomas handles accounts payable. That's the money that the company pays to its suppliers and service providers. He also happens to handle the company's taxes. Susan is a procurement specialist. She works with the company's suppliers and partners to make sure the company always has sufficient resources and that service contracts are up to date. She frequently scouts new vendors in order for Awesome Corp to get the best prices. Thomas is her manager. Ahoy, Financial Department! Of course, there are more departments. Together, all these employees from Awesome Corp, decision-making power flows from the top to the bottom, with a greater concentration at the top. All companies are slightly different, but this will give you a solid start.
Okay, number 2 says, describe your organizational structure. So you really need to give this a lot of thought. We're running through this class and expecting you to do things in like 5 minutes. You may spend 5 days just going over how your organizational structure will work, only to change it again after you actually start implementing things. But one thing they do say here that I like, it says, how will you divide up tasks and responsibilities? That's really where you need to look at it. So some organizations may want in-house lawyers. There's just so much going on with the legal end of your business that you want in-house lawyers. Disney has a ton of in-house lawyers. I remember working with the Mattel Corporation that, they make the Barbie dolls and a lot of other toys. They had quite a few in-house attorneys. I would imagine they have at least a dozen in-house. Disney probably has 50, the Disney Corporation. Wouldn't surprise me at all. So anyway, you look at your organizational structure and you say, what do we do that we have to really, do these tasks really well and be very efficient on? And like I say, it could be legal processing. It could be you need a lot of secretaries for whatever clerical work you have. Or like I said before, you just need a lot of guys swinging a hammer. But what is it you have? If you're in manufacturing, that's what you need. We have a student that's doing yard care. So in his organizational structure, he actually needs people out mowing the lawns or shoveling the sidewalks and the driveways. So he doesn't want to have 5 supervisors and then 1 person out doing 10 houses. You might, but it probably doesn't make any sense. So to be very efficient with the tasks are actually mowing the lawn, shoveling, the snow, and you start saying, okay, how does my organizational structure work so that I get that task done the most efficiently possible?